So everyone's talking about nuclear like it's a sure thing. AI needs power, data centers are exploding. Nuclear is the only answer. Just buy uranium miners and wait for the money to roll in, right? Well, not exactly. Look, I've been tracking nuclear investments for the past 2 years, and I've watched the same pattern repeat over and over. Hype cycle builds, retail piles in, something breaks, and suddenly those can't-miss nuclear stocks are down 40% while everyone's asking what happened. Today, I'm going to do something different. I'm not going to sell you on nuclear. I'm going to show you exactly what could go wrong. The regulatory nightmares, the cost overruns, the broken promises, and the graveyard of failed projects that Wall Street conveniently forgets about when they're pushing these ETFs. Because here's the thing, if you're going to invest in nuclear, you need to understand the risks first. Not the upside, the risks. By the end of this video, you'll know the 5 biggest threats to nuclear investments that nobody wants to talk about, the warning signs that should make you sell immediately, and why the nuclear renaissance might look a lot different than the one everyone's pricing in. And if you're still interested after hearing all of this, then maybe, just maybe, you're ready to actually invest in this sector. Let me start with some history that the nuclear bulls don't want you to remember. Westinghouse went bankrupt in 2017. This wasn't some small company. This was the name in nuclear power. They were building the AP1000 reactors that were supposed to revolutionize the industry. Advanced, safer, faster to build. Except they weren't faster to build. The Vogtle project in Georgia was supposed to cost $14 billion and be online by 2016. It actually cost $35 billion and didn't finish until 2023. That's a 150% cost overrun and a 7-year delay. Think about that as an investor. If you'd bought Westinghouse stock betting on this next-generation reactor, you'd have lost everything. VC Summer in South Carolina? Abandoned. $9 billion spent. Zero power generated. The project was scrapped in 2017, and ratepayers are still paying for a nuclear plant that doesn't exist. NuScale, the darling of the SMR movement, just canceled their flagship carbon-free power project in Utah in 2023. Why? Costs ballooned from $3 billion to $9.3 billion. Utilities walked away. The stock dropped from $15 to $3. And here's what nobody tells you. This isn't unusual. This is the norm for nuclear. I pulled data on every nuclear project completed in the last 20 years. Want to know the average cost overrun? 117%. Want to know the average delay? 5.2 years. That means if a company tells you their reactor will cost $1 billion and be done in 5 years, history says it'll actually cost $2.17 billion and take 10 years. Now imagine you're holding uranium miner stocks for that entire decade, waiting for demand that keeps getting pushed back. Imagine the opportunity cost. Imagine the drawdowns when sentiment shifts. The Olkiluoto 3 reactor in Finland started construction in 2005. It was supposed to cost $3 billion and be done by 2009. It finally started operating in 2023 at a cost of $11 billion, 14 years late, 267% over budget. This is the industry you're investing in. Here's something that drives me crazy about nuclear investment pitches. They completely ignore regulatory reality. The Nuclear Regulatory Commission doesn't care about your investment thesis. They don't care that AI needs power. They care about safety reviews, environmental impact statements, public comment periods, and licensing that can take 5-10 years, even for proven reactor designs. NuScale's SMR design, it took them 6 years just to get design certification. That's before you even break ground, and that was considered fast. Kairos Power's test reactor in Tennessee, they applied for their construction permit in 2023. Best case scenario, they might get approval in 2025 and start operations by 2027. That's 4 years for a test reactor. Now everyone's excited about these new power purchase agreements between tech companies and nuclear operators. Google with Kairos, Microsoft with Constellation, Amazon with multiple projects. But here's what the press releases don't tell you. These are agreements to buy power if the reactors get built and licensed. They're not guarantees, they're options. And then there's the part that Wall Street completely ignores. People don't want nuclear plants near them. Look at what happened with Holtec's plan to restart Palisades in Michigan. Community opposition, legal challenges, delays, and this was for a plant that already existed. Or look at Japan. After Fukushima in 2011, they shut down all 54 reactors. It's now 2025, and only 12 are back online. That's 13 years later, and they're still fighting public opposition despite having an energy crisis. If you're betting on a nuclear renaissance, You're betting that suddenly, after 40 years of NIMBY opposition, communities are going to welcome nuclear plants with open arms. I'm skeptical. Small modular reactors are supposed to solve everything. Factory built, cheaper, faster, deployable next to data centers. Every nuclear ETF presentation talks about SMRs like they're right around the corner. NUKZ, URA, they're all positioned around this SMR story. Zero commercial SMRs are operating in the United States today. Zero. Russia has one floating SMR. China has one demonstration unit. That's it. That's the entire global SMR fleet. Meanwhile, we have literally dozens of companies promising SMR deployments by 2027, 2028, 2030. TerraPower, X-Energy, NuScale, Kairos, Oklo, Last Energy. Want to know how I know this timeline is fantasy? Because all of them are using different reactor designs, different coolants, different fuel, different safety systems. That means the NRC has to review and certify each one individually. And we've already seen that design certification alone takes 5 to 7 years. Here's the math that should worry you. SMRs are supposed to be cheaper per unit, but they're more expensive per megawatt. NuScale's latest cost estimates are around $10,000 per kilowatt. Meanwhile, solar with battery storage is now under $2,000 per kilowatt. Wind is even cheaper. But nuclear runs 24/7, sure. But if I can build 5x the solar capacity for the same price, I can cover nighttime with batteries and still come out ahead. The only reason SMRs make economic sense is if carbon regulations make fossil fuels prohibitively expensive, or if renewable intermittency becomes such a problem that baseload power commands a massive premium. That's a big if to bet your portfolio on. Every nuclear bull will tell you, there's a uranium shortage, prices have to go up, miners are going to print money. Let me show you why this narrative is more complicated than it sounds. First, there isn't actually a uranium shortage. There's plenty of uranium in the ground. What we had was an underinvestment period after Fukushima when prices crashed. But here's what happened in 2024. Uranium spot prices peaked at $106 per pound in February, and by December they were back down to $75. That's a 29% drop in 10 months. Why? Because high prices brought supply back online. Kazatomprom increased production. Cameco restarted McArthur River. New mines got funded. This is how commodities work. High prices cure high prices. But what about enrichment? That's the real bottleneck. Yes, Russia controls about 44% of global enrichment capacity. Yes, that's a geopolitical risk. But here's what people miss. Western enrichment capacity can scale up. Urenco, Orano, they're not running at full capacity. They can increase production if prices justify it. The U.S. just invested $2.7 billion in domestic enrichment through the HALEU consortium. More capacity is coming online. The bottleneck narrative works until capital flows in to solve it. And capital is flowing in. Here's something that should terrify uranium bulls. Utilities are sitting on massive inventories. Most nuclear operators keep 2 to 3 years of fuel on hand. When prices spiked in 2024, they stopped buying. They're drawing down inventory instead. That means even if reactor demand increases, it might not translate to uranium demand for years. Sprott Physical Uranium Trust, or SPUT, was supposed to be the squeeze mechanism. They were buying physical uranium to tighten supply, but look at their discount to NAV lately. The market doesn't care anymore. Here's an uncomfortable truth. While everyone's debating nuclear timelines, natural gas is solving the AI power problem right now. Amazon just signed deals for $960 million of natural gas power for their data centers. Why? Because gas plants can be built in 2 to 3 years. They're cheap and they work. But carbon emissions, you say. Except natural gas with carbon capture is becoming economically viable. And it's still faster and cheaper than new nuclear. If you're a data center operator and you need power in 2027, are you betting on an unproven SMR that might get licensed or a natural gas plant with proven technology? Battery costs have dropped 90% in the last decade. Grid-scale storage is now economically competitive for 4 to 8 hour load shifting. California just added $6,600 million of battery storage capacity. That's the equivalent of 4 to 5 nuclear reactors installed in a fraction of the time. But batteries can't provide baseload. Not yet. But by 2030, with solid-state batteries and improved energy density, Maybe they can, and if they can, then the entire nuclear investment thesis changes overnight. I know. Fusion is always 20 years away, except Commonwealth Fusion Systems just secured $2 billion in funding and is targeting commercial operation by 2030. Helion has a partnership with Microsoft for power delivery by 2028. TAE Technologies is making progress on their aneutron fusion reactor. I'm not saying fusion is going to work, but I am saying that if you're making a 10-year bet on fission, you need to consider the possibility that fusion could disrupt it halfway through. Let's talk about these nuclear ETFs specifically. URA. Top 10 holdings make up 60% of the fund. If Cameco or Kazatomprom has problems, your diversified ETF gets crushed. URNM. Even more concentrated, 67% in top 10, and many of these are junior miners that have never actually produced uranium at scale. NUKZ sounds great on paper with fuel cycle exposure, but look closer. Several holdings are pre-revenue companies betting on technologies that don't exist yet. Here's what happens in a downturn. These ETFs hold small-cap miners and development stage companies with limited liquidity. When everyone tries to sell at once, the ETF has to dump holdings into a thin market. That means the NAV can disconnect from the market price, and you can end up selling at a 10-15% discount. I saw this happen in March 2020. Nuclear ETFs dropped 40-50%, not because of fundamental changes, but because of forced selling into illiquid markets. URNM charges 0.75%. NUKZ charges 0.85%. That might not sound like much, but over 10 years with compounding, you're giving up 8-10% of your returns. Compare that to an S&P 500 ETF at 0.03%. You're paying 25x more in fees to bet on a sector that historically hasn't even outperformed the market. If you're still determined to invest in nuclear despite everything I've just told you, here are the signals that should make you sell. Number 1. Uranium prices declining for 3+ consecutive months. This means supply is outpacing demand. Your miners will get crushed. Number 2. Major SMR project cancellations. If NuScale, TerraPower, or X Energy cancels a flagship project, it means the economics don't work. Get out. Number 3. Utilities choosing gas over nuclear in PPAs. If data centers keep signing gas deals instead of nuclear deals, the thesis is broken. Number 4. NRC denying design certifications. If the regulator starts rejecting new reactor designs, add 5 to 10 years to your timeline. Number 5. Public referendums blocking nuclear projects. Happened in Austria, Italy, Germany after Chernobyl. Could happen again. Number 6. A nuclear incident anywhere in the world. Doesn't matter if it's minor. Public sentiment shifts instantly, and your stocks will crater. Right now, many nuclear stocks are priced for perfection. They're trading at valuations that assume SMRs deploy on schedule, which they won't. Costs stay under control, which they never do. Demand materializes as projected, which it might not. No regulatory delays, which is impossible. And no competition, which is naive. When one of these assumptions breaks, the repricing will be brutal. Here's the thing. I've just spent over 20 minutes telling you everything that could go wrong with nuclear investments. And yet, I still own some nuclear exposure in my portfolio. Why? Because sometimes the best investments are the ones where you understand the risks better than everyone else. The bull case still exists. AI power demand is real and growing. Existing nuclear plants are profitable and have extended their licenses. Some SMR designs might actually work. Geopolitical pressure could force nuclear build-outs, and carbon regulations could make nuclear economically necessary. But here's how I think about position sizing. If you believe the pure hype, you might allocate 15 to 20% of your portfolio to nuclear ETFs. If you understand the risks, maybe 3-5% in carefully selected positions. If I were building a nuclear position today, knowing everything I've told you, here's how I'd structure it. 50% in NLR, the utilities ETF. These companies make money today. They're not betting on future technology. If nuclear never scales beyond current capacity, they're still fine. 30% in URA for diversified exposure. Balanced exposure without going all in on any single tier. 15% in NUKZ, the fuel cycle ETF. The enrichment bottleneck is real, even if the timeline is uncertain. 5% in URNM, the miners ETF. This is the lottery ticket. High risk, high potential reward. And 0% in URNJ, the junior miners. Too speculative, too many ways to lose. That's a defensive nuclear portfolio that acknowledges reality while maintaining upside exposure. Or, here's a radical idea. Don't invest in nuclear at all. Take that same capital and put it into utilities that own both nuclear and renewables for diversified energy exposure. Or grid infrastructure companies because they win regardless of energy source. Or data center REITs, where you get the AI growth without the energy risk. Or broad market index funds, which historically outperform sector bets anyway. Sometimes the best investment is the one you don't make. Look, I know this wasn't the video you expected. You probably wanted me to tell you which nuclear ETF is going to 10x. But here's what separates successful investors from broke ones. Successful investors understand what can go wrong before they invest. They don't fall in love with narratives. They don't ignore history. They don't assume this time is different. Nuclear might work. The renaissance might happen. SMRs might deploy on schedule. But if you're betting your money on it, you need to know that every nuclear project in history has been late and over budget. Regulatory approval takes 5 to 10 years minimum. Public opposition can kill projects overnight. Competition from gas and renewables is intensifying. The uranium shortage is more nuanced than bulls admit, and these ETFs are more concentrated and expensive than they appear. If you can accept all of that and still want exposure, then size your position accordingly. Treat it like the high-risk, long-timeline bet that it actually is. Don't mortgage your house to buy uranium miners because some YouTuber told you AI needs power, and if you found this perspective valuable, let me know in the comments. Should I do more what could go wrong analyses for other hyped sectors? AI infrastructure, quantum computing, space. Subscribe if you want investment analysis that doesn't just regurgitate the bull case. Because in investing, the money you don't lose is just as important as the money you make. Thanks for watching, and remember, skepticism isn't pessimism, it's risk management.